Hey everyone, welcome back to Corporate Decoder. Today NVVE just filed their first quarter 2026 report and I am seeing revenue growth but a massive red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing strong revenue increases in services and grants, but a significant increase in operating expenses and a still substantial net loss. Let's dive into Nuvve Holding Corporation's financial report for the first quarter of 2026. This is their 10Q filing, giving us a look at how they're doing financially in the first 3 months of the year compared to last year. First, let's check out their balance sheet. This tells us what the company owns and what it owes. As of the 31st of March 2026, Nuvve had about $1.7 million in cash, down from over $5.4 million at the end of 2025. They also have accounts receivable, meaning money customers owe them of over $1.2 million. Inventories, which are goods they have on hand to sell, are valued at around $786,000. On the flip side, their total liabilities, or what they owe, are over $15.3 million. This means they owe significantly more than they own right now. Now let's look at their income statement for the 3 months ending the 31st of March 2026. Total revenue jumped to $1.39 million, a solid increase from $934,000 in the same period last year. This is a 49% gain, which sounds great, but it is important to see where that revenue is coming from. Product sales actually decreased by 22%, but service revenue shot up by 164%, and grant revenue also saw a big jump of 142%. This suggests that a lot of their growth is coming from services and grants, not necessarily from selling their core products as much as before. The cost to produce their products went up 18%, but the cost of providing their services saw a massive 135% increase. This is a concern because while service revenue grew a lot, the cost to deliver those services grew even faster. Their selling, general, and administrative expenses, which cover things like marketing, salaries, and legal fees, went down slightly by about 4% to $4.89 million. This is good to see some cost control here. However, research and development expenses increased by a huge 82%, coming in at $1.6 million. This means they are investing heavily in developing new technology, which is often necessary for growth, but it also adds to their expenses. All of this led to an operating loss of $5.84 million for the quarter, a slight increase from the $5.58 million loss last year. Then we get to other income and expenses. Interest expense went down significantly because they seem to have less debt or have refinanced it at better rates. But the change in fair value of warrants and investment rights liability saw a big swing, moving from a loss last year to a gain this year, which is good, but it is a non-cash item. This all resulted in a loss before taxes of $5.6 million, which is actually an improvement from the nearly $6.9 million loss last year. But after all the adjustments specifically for preferred stock dividends and accretion, the net loss attributable to Nuvve Holding Corp. Common stockholders was $5.83 million. This is a significant loss per S-share, a negative $28.96. This massive loss per S-share compared to last year's $27.92 loss. Per share is likely due to some stock splits that have been applied retroactively, so it is important to look at the overall dollar amounts. Looking at cash flows is crucial. During the first 3 months of 2026, the company used $6 million in cash from operations. This is a big jump from the $1.8 million they used in the same period last year. This means they are burning through cash faster to run the business. Financing activities provided about $2.2 million in cash for the quarter, mainly from issuing convertible preferred stock and some warrants. This is how they are funding their operations, by bringing in money through stock and debt. This brings us to liquidity. Nuvve states they are still an early stage business and expect to continue incurring substantial losses. They've got a cash balance of $1.7 million, but a working capital deficit of $2.8 million. They are relying on raising more capital, which is a common theme for companies at this stage, but it also means they are highly dependent on outside funding. The news highlights this concern with revenue at $1.39 million, but a significant loss per S-share of negative $28.96. This is a stark picture of their current financial situation. And here is the really crucial part: the filing flags. They explicitly mention a going concern risk. This means there is a substantial doubt about their ability to continue operating for the next year without raising more money. This is a serious warning sign for investors. Following their report, the stock has seen a big drop. This is often a reaction to the going concern warning and the overall financial results. Adding to the story, they announced a 1-for-18 reverse stock split, which happened in July 2026. Companies often do reverse splits to boost their stock price and avoid being delisted from exchanges like Nasdaq. For example, when Kodak did a 1-for-20 reverse split in 2021, holders saw roughly a 40% additional drawdown over the following 90 days. A $1,000 position there became about $600. This kind of move can be a sign of trouble, as it doesn't fix the underlying business issues. The filing also discusses their ongoing struggles with Nasdaq's listing requirements. They've had issues with minimum stock price and stockholders' equity, and while they've been granted extensions and seemingly met some requirements, there is a constant threat of being delisted. If they get delisted, selling their stock can become much harder, which is bad news for shareholders. Another significant point is their internal controls. Management themselves stated that their disclosure controls and procedures were not effective as of the 31st of March, 2026. They cite insufficient resources in legal and accounting departments and a lack of formal written policies. This is a pretty serious admission that could impact how reliably their financial information is prepared and could lead to regulatory issues. Looking at the big picture, Nuvve is in a tough spot. They're growing revenue in some key areas, especially services and grants, which is positive. However, their operating expenses, particularly in research and development, are growing rapidly, and they're still burning through cash. The explicit going concern warning is the most significant risk right now, suggesting they depend heavily on future funding. The reverse stock split and ongoing Nasdaq listing issues are also major red flags. They need to show a clear path to profitability and sustainably fund their operations, or they could face significant challenges ahead. The big story here is Nuvve's struggle to achieve profitability. Despite revenue growth, coupled with their reliance on external funding and the persistent risk of delisting from Nasdaq that could impact investor confidence. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.